One component that often remains shrouded in mystery is how fixed rate mortgages are actually set in Canada. Here's a little spoiler. It all goes back to the 5-year Government of Canada bond yield. What is the 5-year bond yield, you ask? So I want you to imagine that you have money saved up and you want to invest it somewhere safe so that it can grow. One option available to you is to actually lend your money to the government. This is the 5-year Canada bond yield. So an investor lends money to the government and the government offers and guarantees a percentage rate of return after 5 years. So let's say the 5-year Canada bond yield is at 3% today. You lend them $100 and in 5 years you get your $100 back plus $3 to account for the 3% they promised you when you originally invested. Since the bond yield is backed by the government and considered supremely secure, banks and lenders actually use the bond yield as a reference point for coming up with the fixed rates that you see advertised on mortgages. Banks and lenders look at where the bond yield is at any given day to see what the government is guaranteeing or promising as a rate of return. Then, banks and lenders consider their own costs to lend the money, what risks are involved for them, and what profits they hope to make. They add that onto that bond yield base rate, and voila, we have fixed rate mortgages. So an easy way to understand it is this. When bond yields go up, banks typically raise fixed mortgage rates. Conversely, when they go down, so too can the rates offered to you by these banks and lenders. Now, I get this question a lot. Eric, is this just fixed rates, not variable? So while bond yields affect fixed rates, they don't directly impact variable rates. Variable rates are influenced by the Bank of Canada's policy interest rate. This is akin to the throttle of our country's economic engine. So when the economy needs a little bit of a jolt, the rate drops, making borrowing cheaper. Should the economy overheat and need cooling, as evidenced by the past 2 years, the Bank of Canada raises rates with the intent to slow down demand for borrowing and spending. So, taken as a whole, as a potential buyer or even existing homeowner, grasping this aspect of your mortgage is super crucial. By embracing this knowledge, you actually empower yourself with the foresight to navigate the path to home ownership properly.